Hey guys and girls, good morning. Location somewhere inside the Lodi Gardens. Topic, the value of cash. And the reason I want to talk about this is because I find that a lot of people, a lot of analysts really, they think cash is a very easy asset to value. And I'm really talking about surplus cash. Now, what do we mean by surplus cash? Now we're talking about businesses which generate cash, have that on the balance sheet, have no debt or have little debt and have some current liabilities, but the cash is over and above the debt and those current liabilities. Now, what is the typical methods used by analysts when they look at this number? They call it surplus cash because it's in excess of the debt and the current liabilities. So how do they think about this number? I feel that there's a tendency to value that cash at face value. When you are evaluating the quality of the business, you'll treat it as a non-operating asset. You will remove that from the balance sheet. You will count the remaining operating assets and then compare the operating income without considering any treasury income and compare that to operating assets. So operating income to operating assets calculation requires you to remove the excess cash and the income from that cash. You remove the excess cash from the balance sheet, you remove the treasury income on that excess cash from the P&L. So that's one, and there's elegance over there, and that's correct way of thinking about evaluating the quality of our operating business, because you're really trying to get to what is called as a core ROE of the business. The other thing that analysts do is that when they are valuing these businesses, they take the market cap of the company. Just to keep things simple, I'm talking about a debt-free company which has so-called surplus cash on the balance sheet, well in excess of and current liabilities. How do analysts think about this excess cash when it comes to valuing a business? So what the typical method that is used is, they would take this cash, they would net it off from the market cap, and they come up with what the market is paying for the value of the business, or what you call as EV. And then they compare that EV with operating income and come up with some notions of cheapness or expensiveness given based on the multiple that they arrive at when they make the comparison between EV and operating income. So these are the two things: how you treat that cash when you are evaluating the quality of the business, and how you treat that cash when you are actually valuing the business. So that's the standard method, and the logic there is that this cash is surplus and therefore it should not be counted towards valuing the business or towards evaluating the quality of the business. So that part is fine, I don't have a problem in that. But I have a problem with the definition of the term surplus. What do we mean by the term surplus? What is the meaning of surplus? I mean, let me just give you some examples of situations where the cash that is on the balance sheet is in excess of debt, is well in excess of current liabilities, but is not surplus. So what could that be? Well, one example is seasonal companies which have seasonality in demand. They have peak seasons and they have lean seasons. And when there is a peak period, they end up with the cash sort of disappears. It becomes inventory, it becomes receivables. So, and when the period is lean, all that inventory and receivable becomes cash and it comes back to the balance sheet. And at the balance sheet date, on the date on which you are looking at the number in the balance sheet, on that date, if there is a lot of cash, you may come to the impression that it is surplus, but it is really not surplus. So that's one example of seasonality. There's another more important example here which I want to highlight and develop and delve more on that. So that example is money that is lying on the balance sheet which is not yet become operating assets, but there's a strong prospects that they will be converted into operating assets at some point of time. Condition number one. Condition number two, those operating assets have, historically speaking, delivered exceptional operating income on those assets, and therefore the possibility of the conversion of that so-called excess cash into operating assets has tremendous value. So the question then becomes, when will this cash become capex? When will this cash become plant and machinery? When will the company expand capacity and deploy more capital, not only in fixed assets but also in working capital? Because as you expand, you need money both for fixed assets and you need money for working capital. Now there is this cash on the balance sheet, and which is seemingly excess right now, and the business over the long term has delivered exceptional operating income on operating assets. So how should analysts treat this situation is what I want to talk about a little bit. I also want to talk about the idea of paying dividends. Of course, if there is cash on the balance sheet which is surplus to the current needs of the business, we don't need it right now because there is no immediate plan to deploy it in additional working capital or additional fixed assets. The shareholders, when they meet the management in the annual meetings, they are typically want that cash to be paid out to them, and there is a reason for that, and is usually a very good reason. And the reason is based on a theory that was once talked about by Peter Lynch in one of his wonderful books. I don't remember the name of the book, but the theory I remember, and he called the theory the bladder theory of corporate finance. And he basically was talking from experience, and I've had the similar experience, and the point that he was making was that the more the cash that builds up in the treasury, the more the pressure to piss it off. So there is this tendency to misallocate capital. There is this temptation that when you have too much cash on the balance sheet, you should pay it out to the shareholders. And that's a good point that shareholders often make. But are they always right? Let's look at, what they say, and what many analysts also say, is that, well, this cash on the balance sheet is earning only 5%, the operating assets are earning 35%, and this cash keeps becoming bigger and bigger part of the balance sheet. It is pulling down the ROE of the company. And because when you combine assets which are earning 5% with assets which are earning 35%, and the proportion of assets which are earning 5% keeps getting bigger and bigger every year because the earnings are coming in and are not going into new plant and machinery, not going into additional working capital, then clearly the ROE of the company will come down. The ROE of the business will not come down, the operating business will not come down, but the ROE of the company will come down. And the logic, the hypothesis here is, I'm not buying the business, I'm buying the stock in the company, and therefore I have to worry about the ROE of the company and not the ROE of the business. Now this is a debate that I don't want to get into right now. I really want to say that there is this hypothesis, or there is this logic given by analysts and stockholders that pay this money to me, you don't need it right now, you will piss it off, you will unnecessarily, by holding it, bring down the ROE of the company. I don't like that, markets don't like that, the valuation will come down, give the money back to me. So there's logic behind that. But let's look at the problem from the point of view of the entrepreneur, the people who run the company, people who actually do the dirty work of running the business instead of stockholders who are essentially riding on the coattails of these entrepreneurs. So what do these entrepreneurs think? Well, there are basically two types here. The good guys and the bad guys. Now the bad guy thinks along the following lines: this is my company, this is my money, even if I don't own the shares, even if I don't control all the shares, I control the company, and therefore I get to decide what happens to the company. The shareholders have no right whatsoever to decide what happens to the cash. I will decide, and I will take this money. It's my money basically. Now of course that's a governance issue, and investors should be very wary of investing in these companies if they want to be conservative investors. But there's the second kind of an entrepreneur who's a good guy. How does he think? Well, he thinks along the following lines. He says, I need financial flexibility. This is a cyclical business. These good times are not going to last. Right now, cash is coming in, things are going very well, and I need to build ammunition for a battle that is coming because the slowdown is coming. And I know what my competitors are doing. They're doing a lot of dumb things. They are building capex and they are expanding recklessly. And it's only inevitable that in this cyclical industry, there will be a down cycle. When that comes, I want to be the last man standing. I want to be holding cash on the balance sheet. I want to be liquid because that liquidity gives me financial flexibility, and that financial flexibility has value. So we're coming to the point, which is what I want to get to, that cash is not an easy asset to value. Cash has got huge option value. There's optionality attached to cash. There's option value attached to cash, and we have to recognize that. Now, the important thing to recognize when I made the distinction between the good guy and the bad guy is a very simple one, is a very logical one. I think you will get that. Is that cash in the hands of a crooked person or in the hands of a allocator of capital who doesn't know anything about allocation of capital and who has a tendency to sort of piss it off. He adheres to the bladder theory of corporate finance, and there are so many companies out there, I won't name them. Well, in those situations, in governance issues or in misallocation of capital issues, cash should not be valued at face value. That cash is worth less than the face value of that cash. But then there is a flip side to the story, and the flip side is there are sometimes, not very often, great allocators of capital who are also ethical and are shareholder friendly, and they have the ability, they have the capability of compounding that capital at a very high rate of return. It's just that they don't want to do it right now because they need financial flexibility, but the track record of these guys over a long period indicates that they know how to compound capital. So how do you value cash in the possession of these people? I think you will agree that this cash should logically be worth more than the face value of the cash on the balance sheet. Now, let me develop a little bit on the option value of cash. That's very important because one of the theories in corporate finance is called option pricing model. Well, I don't trade in options, and I did study Black-Scholes option pricing model, and I love the elegance of that model. I want to pick up just a couple of ideas, maybe one idea from the option pricing model in thinking about the option value of cash. So there are really 6 variables. There are 6 variables that go into the calculation of the value of either a call option or a put option in the option pricing model, in the Black-Scholes option pricing model. What are those 6 variables? Well, they are the exercise price, the stock price, the volatility, the time to maturity, interest rates, and the interim cash flows if there are any. So there are 6 variables over there. Now let's just focus on 2 of them. One of them is volatility, and we know that whether you are valuing a call option or a put option, the higher the volatility of the stock price, the more the value of the call option and the put option. So other things remaining the same, if you jack up the volatility, the value of the call option goes up, the value of the put option goes up. So the essence of the idea that I want to focus on is that option values are directly proportional to the inherent volatility in the system. So now let's just shift the focus from volatility of the stock price to the volatility of the business, to the volatility of the cash flows. And the analogous idea that I want to talk about is that anytime you find businesses where there is inherent volatility in the cash flows go up and down like a yo-yo, or there is very significant change that is happening in the industry. There's a lot of volatility that is happening in the industry. Good morning. And there is a lot of change that is happening in the industry under those 2 conditions. A lot of change in the industry, very cyclical or volatile cash flows. Clearly, the logic is valid. The logic of valuing options is valid here. The value of cash in these situations will be more than cash in situations when you're looking at a very stable business with very little volatility in cash flow. So if there is inherent stability in the business model, the value of the cash as an option will be less than in situations where there is a lot of volatility in the business model. So that was one. The second variable that I want to focus on, time to maturity. Again, if you remember option pricing model, keeping everything else the same, if you increase the time to maturity for the exercise of the option, whether it is a call option or a put option, the value of the option goes up. The same logic applies here. If the entrepreneur is having difficult time right now, if the period is not good and he's sitting on cash and that cash buys him time, that buys him time to get out of trouble, that gives him the ability to breathe, to be able to survive, to be able to meet expenses when there is no income. I mean, we are going through that period right now, so I think you understand what I'm saying. In those situations too, the value of time, because you have now got breathing room. The others don't have it, you have it because you have cash on the balance sheet and they don't, and that has value. So in both these situations, whether you're looking at time to maturity or at volatility, you have exceptional value to be added to the cash. Now I'm not going to do the math. There's no need to get into the mathematics of option pricing model here. The important points here is to pick up the essence of that model and try to think about it in terms of valuing cash on the balance sheet. Okay, now let me summarize. It's easy to think that cash is very easy to value. It's not. Cash has low income value, but it has high option value. If you think about cash in terms of the treasury income that it earns, its value is not significant. But if you think that there is option value to that cash, then the value could become very significant depending upon the circumstances, the kind of circumstances that I described to you. So that was one. Sometimes the cash that you see on the balance sheet is worth a lot more than the face value of the cash that is on the balance sheet. The intrinsic value of the cash is a lot more. I mean, just think about the DCF point here. Imagine that there is an entrepreneur who has a long track record of compounding capital and has been doing it at 30-35% a year for a long time, and right now he's sitting on this excess cash. And the industry has prospects to grow over a period of time, but it's just that he doesn't want to do it right now because it is a cyclical industry and this is not the right time to do it, and therefore he's building treasury. And when you ask him, when will this cash become fixed asset, he says that it will be at least 3-4 years. Until then I'm going to build treasury. I'm not going to do capex because there is no need to do capex right now. This is not the right time to do capex. Now if you do the DCF, if you treat this cash for the next 3-4 years as a 5% asset and then convert it into operating asset which will be earning 35% return on itself, CAGR, for a long time thereafter, then in DCF terms, in present value terms, the value of that cash today will be significantly more than the book value of cash. Now once you understand that, why the hell would you value that cash at face value? Why do you want to take the easy way out? Why not think deeply about this cash and what it could become, what it is likely to become, whether it is going to be squandered away in stupid diversification attempts, whether it is going to be stolen from the minority shareholders, or rarely, but not that rarely, there is a strong prospect of it being converted into an operating asset that has an ability to compound itself at 30-35% per annum for a long time. Now, if you did that, you will come to very different conclusions about the true value of the cash on the balance sheet. That was the second point. And the third point is that, of course, if the cash is in the hands of a crooked person, it's probably worth nothing at all. Minority shareholders should recognize that. Corporate laws do not allow shareholders to insist upon dividends to be paid to them. Dividends are discretionary. The board of directors decides to pay the dividends. They may decide not to pay any dividends, while the shareholders will elect the board of directors. But if the founding family controls 60% of the shares or even 30% of the shares, they often have effective control on the business, and they control the board of directors and they control the dividend decisions. So they may, in their own wisdom, decide not to pay out anything. Now, analysts and investors should recognize this and treat these situations as value traps. The cash that is there looks attractive, but it's almost always a sort of a trap that is attracting you to buy into these situations. It should be avoided, in my view, if you want to be a conservative investor. And it's important for investors to be able to discriminate between these situations, that whether the cash that they're looking at on the balance sheet, is it in the hands of a good guy or a bad guy, and the treatment of that cash will obviously be different in these two situations. And with that, I say bye to you today.